Welcome to the Jill on Money Show. It is Sunday, November 24th. And today we're continuing our conversation with Marlena Lee. She's the Global Head of Investment Solutions at Dimensional. And if you did not listen to yesterday's episode, listen to that one first because she gives a really good explanation of Dimensional. Today we're talking about the evolution of the firm, what has happened, and how Dimensional has really changed as markets have changed and access has changed. So today we've got the second part of our interview with Marlena Lee. Here we go. All right, question. So I get the whole dimensional approach, which I love because there is, it's not saying we believe that indexing is bad. It's we believe that indexing is leaving money on the table. Now, the thing that's interesting about Dimensional, so I'm just also going to go back in time, everyone, because I was an investment advisor 100 years ago, and I was the chief investment officer. And before I left my firm, my goal was, when I sort of handed over the reins, I said, I had done the exact same sort of thought process around, index funds. And I thought, what we really need to do? We just need to just be dimensional. Now, at the time, dimensional was only available if you worked with a financial advisor, financial planner. And what was important about that decision in the early days of dimensional that you wanted to make sure, in other words, you weren't going to just say like, hey, any Tom, Dick, and Harry can buy a dimensional fund. It was important that you had the advisor as the interface. Why was that?
Yeah, well, I think a lot of the value that Dimensional brings, it just takes a bit more understanding. And it's easy to say, I have this S&P 500 fund, and it should be tracking the S&P 500 index. So there's basically no really need for education on the investment approach. You just kind of, that number matches that number and we're good. When it comes to dimensional, because we're not tracking an index, and because some of these tilts that we take in the portfolio to pursue, let's just say the size premium or the value premium, they don't always work, right, Jill? We were just talking about this. In our mind, it's really important for people to understand the performance and why we might look different from an index or the market so that they could stick with it for the long term. Because we were just talking about what do investors need to do to have a successful investment experience. Being able to manage their emotions and sticking with their investments over the long term, even when results are maybe not as great as they were hoping, is so important. So we worked with financial advisors because first we wanted people to really understand our approach and be able to get that discipline, that long-term perspective, so that people were not kind of bailing at the exact wrong times. We also think that there's just more information these days about Dimensional's approach. Like, the market has kind of come our way. Before, when we were first getting going, we were the only ones out there talking about like this factor-based approach to investing. Everything else was stock picking or index funds. And over time, we've seen a lot more people just become familiar with Dimensional's approach. So while we still want the opportunity to educate investors on this approach so that people know that there's, good ways to outperform the market that's not reliant on a crystal ball. We can do that even though there are investors, anyone could buy our ETFs today, for example, without going through an advisor.
And what is so wait a second, but in the beginning, it was only through an advisor. Then that for the funds, and then you guys, and when did you create the ETFs that were available to anyone?
Yeah, so the ETFs, we launched our first ones in 2020. Right as there was a change actually in the regulation for ETFs, and that happened in 2019, and that really allowed Dimensional to come into the ETF space. So we launched a few. At this point, we have 40 different ETFs.
That seems like a lot. So can't we just couldn't you give us 5? That seems like way too many. 40?
Well, The advisors we
Jesus.
work with keep asking for more.
Oh my gosh. Okay. So obviously, an advisor can use the ETFs, but anyone who wants to type in the QSIP or the symbol, they can buy your ETFs, and just anyone. I mean, it's sort of early days, so it's only like 4 years. But I guess I'm wondering, do you find there's more turnover in those ETFs because there's not the advisor in between the investor, the end user, and you guys? In other words, it's such an interesting case study that if people got like, oh no, I bought this ETF and it underperformed the S&P 500, I'm out. And I wonder how much more that happens to individuals without the advisor.
Well, that's actually a key difference between a mutual fund and an ETF. Is in a mutual fund, we want to have the advisor there to prevent, you're kind of describing hot money, right?
Mm-hmm.
So markets underperform or the premiums don't show up and people want to bail. That's exactly what we want to prevent by working with advisors. And it's really important in mutual funds. In ETFs, you actually want higher volumes.
Mm-hmm.
So if someone wants to time markets using a dimensional ETF, that's actually okay.
Okay.
And I mean, not okay from the perspective of that's just a bad investment idea, but okay in that activity, that volume in the ETF helps keep spreads in the ETF tighter.
Okay.
So the ETFs are available to anyone. They don't have to go through an advisor. Therefore, if they wanted to, try and trade these things way more than they should, the worry there of it causing negative ramifications on the long-term holders, that's not really relevant in an ETF. So anyone can invest. We still really want the opportunity to have people understand our investment approach, but we can't force them. We can't say, you have to come to our conference before you're allowed to buy the ETF. That's just not how ETFs work.
What's your view on this concept that you hear thrown around that like, oh, we plebes will never get great returns because we won't get into like the actual interesting hedge funds that may be able to outperform. They say they do. I don't know if they do. Or that like, oh no, you have to be in private equity. I have a friend of mine, shall remain nameless. Let's say he's got good money, but he was with an advisor and the advisor kind of gave him this is actually a dimensional advisor who kind of gave this guy lots of different dimensional funds, mostly did a lot of the hardcore planning, explained the difference. This guy is a really smart guy. And you know what? He could not stand it because he felt like in the last, 8 years since you've had my money, I could have just owned the S&P 500 and been better off. And explain. So where does he go? He goes to Goldman Sachs Asset Management, where he is promised to have access to private equity, to this hedge fund. What are the results that you have found in those other either private or hedge fund results that they tout themselves as like, we're only for the big smart people? Do they really deliver or not?
Such a great question, Jill. I would say first, a public market, let's just call it 60-40, or maybe it's 50-50, whatever the ratio is of stocks and bonds, that's a pretty dang good portfolio.
Right.
And to me, that's like the hurdle for, okay, can you beat just a regular public markets portfolio by investing in hedge funds or whatever other esoteric combination of assets,
Right.
privates, alternatives. I think that there's first the data on alternatives where we can see good data. Mm-hmm. So there's some more public alternatives, like things that are listed where they're ETFs or mutual funds. They may do traditional hedge fund type strategies like long short. That if you look at the performance of those categories in Morningstar, where they have to report returns because they're either ETFs or mutual funds, that the performance is not that great. Generally, the fees are quite high. Often there may be high turnover. So they do not appear to add much to a basic 60-40 portfolio.
Okay.
And then we kind of move from there into places where the data is just not as good, where we can kind of make an inference from that data of how do hedge funds work. Generally, I think the consensus is that hedge funds are not adding much value to investors at all and just taking very high fees. So hedge funds, I think, have I don't see them coming up that often anymore. I think a lot of people understand that they haven't really added value. Really, where I get a lot of the questions, or I think these days, alternatives is used almost synonymously with private capital, private equity, private fixed income. And at Dimensional, we did have our research team put together a paper where they looked at the performance of private funds. And I'd say that there were there's always caveats with this data. So they did try and get the best data set that's out there. A lot of times this data may have biases in it. So they source the data from a place where I think a lot of the biases are thought to be more minimal. And then what we find is there is, first of all, a huge range in manager outcomes. So way bigger than what you'd get in public markets. So manager selection becomes pretty important. Like the difference between finding a top quartile manager versus a bottom is huge. If you add up all of the funds and like stick it all into like a well-diversified portfolio of private investments, they do behave differently from public markets. So there's probably some diversification benefit there. But again, there's that trade-off where even if there is diversification benefit, you're also adding in potentially manager risk. So that's a trade-off. And I think that that's really an important consideration is, do you think that you're going to get the best pick of managers? And if you can get a top quartile manager, that's great. I think everyone who invests in privates all think that they're getting top quartile, but that obviously mathematically can't be true.
Yes.
So I think that's the rub. And I also don't think that anyone really needs it. Like a 60-40 portfolio is pretty good.
So I love that you said that, because, I have friends who have asked me about like, well, what do you think about Citadel or D.E. Shaw and these big places that have, I haven't looked at the numbers, but let's just say, let's throw them in the top quartile for fun. And I said, well, you're going to put all of your money there? You're just going to put a chunk, like some chunk. Well, no, I'm going to put 5%. Okay. You have $10 million and you want to put some money in there, or you have $50 million and you're going to put some money there. Is it really going to change the outcome of your life or your performance over time? Maybe a little bit, but it's always going to be, you're not going to put all of your money with these people. That's the thing that like, I feel like we lose sight of this, that like, and when you say 60-40 is a pretty damn good portfolio, that's how I always feel. It's like, why are we making this so complicated? It's not that complicated. And whatever incremental, outcome you get, that's great. But, your money is locked up and all those things take time. And it's just fascinating to me. I would really much prefer if people spent more time worrying about like how they've crafted a really smart estate plan and done real tax planning instead of like picking alternatives that they think are going to outperform, because I think it's just nonsense. But that's me, and I'm editorializing. Marlena, what do you think people misunderstand about investing if they're do-it-yourselfers? What do you think they're really misunderstanding? We've talked about how you might be leaving money on the table, but what else do you think is important for people to focus on as they're looking at their personal financial lives?
I think you hit on it. So when it comes to investing, I think that the biggest misconception is that there is magic to it. That you need to find the next big thing before it becomes the big thing. Investing, I think, should be really boring. You should invest in a really well-diversified portfolio and generally don't touch it. And that I do think is hard for people to take, because in everywhere else in life, the smarter you are, the harder you work, generally the better you do. But that's not the case in markets, because markets, it's a zero-sum game where for someone to win, someone else has to lose. Right? If someone has a great buy, someone had to sell that stock to them. So there's two sides to every single trade, and everything has to add up to the market. So it's not the case where if collectively all investors are smarter and work harder, it's not the case that they can all outperform the market. Whereas in the rest of the world, we could have a more productive economy or something like that. Like there's actually positive benefit associated with that activity. So I think that that's a big thing for people to realize that they don't actually have to have a crystal ball, that they can buy it, they can invest in something as long as it's well diversified and pretty low cost, that it shouldn't actually change much. And then they can focus on the more planning side of things, making sure that, to your point, Jill, that like their beneficiaries are, or even that they have kind of an estate plan. That's so important. Tax planning is so important. And also just, you have to save in order to have money to invest. So
yeah, really.
So how much are you saving? Are you saving an adequate amount? All of those things, I think, are what's going to really move the needle in terms of retirement preparedness relative to, oh my gosh, which ETF should I be in?
When you want to talk to people about where you are, like the patience, no crystal ball, isn't it fascinating? But human nature wants somebody to know. What is it that is like so hard about that? Is that like the human nature wants, I think, to also to be like think that there's some control over this. Because if you just say, there's no magic to this, investing should be boring, then I wonder for someone like you, if you think the advent of a lot of like hot money trading platforms has been bad for investors. Do you think that?
Oh, yeah, absolutely. I think investing should be, regardless of what's happening in your everyday life, like elections or whatever news headline of the day, that should very rarely impact your portfolios. The only things that should impact your portfolios are changes in your own circumstances. If you lose a job, if you get married, if you have kids, it's or if you just change your own personal financial goals. Those are the things that should impact your portfolios. And if anyone has trouble imposing that type of discipline or that framework mindset, I absolutely think that there's value to having an advisor that subscribes to this way of investing.
Right. And do you find that the investment advisors out there, the financial planners out there, that once you educate them about dimensional, if they're bought in. Like what I find, or what I used to find, was that, like I said, it was sort of like an evangelical feel to like people who use dimensional funds were all in. And you have a vibrant community of advisors that all talk to each other. And this was actually how I came to learn about you, is that I knew one of my competitors at the time was saying that he was in a study group with a bunch of other dimensional advisors, and they were like trying to brainstorm ideas about some of their hard to solve client problems. I find that fascinating because it's crossing over different companies. And I don't know if the big company, I don't know if you like at Morgan Stanley or Merrill Lynch, there is as many people. I tend to think of you guys as like sort of like part of big individually owned firms. But that kind of collaboration is very interesting to me. Can you talk a little bit about that?
Yeah, so you described it well, Jill. Yes, we work with a lot of independent financial advisors, and in some sense, because they're all at separate firms, they might think of themselves as competitors. But I think one of the things that pulls that community together is the real enemy, so to speak, out there are ones who are more pushing products that are not good for investors, that are thinking not from a fiduciary perspective of like, how do you line your own pocket and not putting your investors first. I think that's the common bond across a lot of the advisors we work with, is that they see that and they do want to put their investors first. And they see that this approach is the right way to do it. And the evangelical, or the part that I also want to hit on there, is if you actually let go of this idea that you can beat the market with a crystal ball, that is so freeing for investors, for advisors, because just think about if that's your method of adding value. First, none of the evidence shows that you can do it all that robustly or successfully over time. But second, the amount of time that you have to spend trying to figure out what to buy or sell and when, and get that all right, and then explain that to your investors, especially if you get it wrong, that is a huge amount of time that could be allocated to thinking about planning, to it's just such a bad use of time, where I think that that's another just place where Dimensional can help, or the community of advisors that are all trying to communicate this type of investing can share and learn from each other in order to be more efficient and then compete on the things that actually matter, like tax planning. So, I do think that that's still alive and well, even though today these advisors don't have to go through Dimensional to access, for example, Dimensional ETFs. But I do think that there's a learning community. That's what attracts a lot of people to Dimensional, is that there is a bit of a nerdy, wonky edge to what we do, but also just sharing best practices on how to handle client situations.
If you've got a question about whatever's going on in your financial life, we are here to help you out. Just go to JillOnMoney.com, click the Contact Us button. Let us know if you'd like to join us on the air by checking that box, and then Mark will do everything else. While you're on the website, you can check out all of our resources that are free. You can watch videos, you can read the blog, lots there for free. And of course, if you've got a few bucks to spend, I encourage you to join Jill on Money Live for $35 before Mark jams up the price for next year. He is going to do it this year, he swears. You can subscribe to us on the Odyssey app or wherever you find your favorite podcast. Try to do something nice for someone else today. Change your work, change your wealth, change your life. Thank you for listening, and we'll talk to you tomorrow.